April 20th, 2020. On the New York Mercantile Exchange, a number appears that the matching engines were never built to believe. West Texas Intermediate, the American crude that sets gasoline, jet fuel, and 1,000 forecasts, prints a minus sign. Not a discount, not a pause. Negative $37.63 for a barrel still coming out of the ground. The floor does not cheer. Screens flicker. Algorithms hesitate. For a few seconds, the world's most watched energy contract looks like a glitch. Then the glitch holds. Traders are not being paid to own oil. They are paying other people to take it away. 5 years on, the maps have changed and the veto has not. On August 14th, 2026, Ukrainian drones hit Russia's Baltic export port at Ust-Luga. A fire climbs the terminal. A governor confirms the strike. Tankers wait on water, while spreadsheets wait on steel. Markets twitch not because a speech changed, but because a harbor, a pump, and a tank farm can still overrule a model. The same veto lived in Oklahoma long before those drones flew. Physical infrastructure remains the last hard edge of a market that pretends to be weightless.
Pipelines have diameters. Tank farms have lids. Ports have berths. A futures book can multiply a barrel 1,000 times on a screen. It cannot invent an empty tank. That is the contradiction. In the first pandemic spring, paper oil and wet oil slammed into each other at a rail town most drivers have never heard of. Wall Street had bought a promise of delivery. Cushing, Oklahoma had almost nowhere left to put the stuff. The contract did what contracts do when the world underneath them fills up. It shoved the price through zero. The print was not a gift at the pump. It applied to wholesale delivery at one choke point on one expiration under rules written when no one imagined a barrel could be worth less than nothing. Ordinary drivers were not paid to fill their cars. A cluster of financial positions trapped against steel were. The question is not how a ticker went red. The question is why a prairie tank farm still sits inside a multi-trillion-dollar derivatives machine. And what happens when that farm, for 1 week, has no room left?
Cushing does not look like a capital of anything. It sits in Payne County, Oklahoma, a grid of tanks, pump stations, and pipeline junctions that grew because geography was cheaper than argument. Early in the 20th century, the mid-continent fields needed a place where crude could be gathered, measured, and sent onward. Rails came first, then steel pipe. By the time the modern American oil market needed a single postage stamp for delivery, the town already had the junctions. In 1983, the New York Mercantile Exchange listed a light sweet crude contract designed to be settled not by a survey of opinions, but by the physical transfer of barrels at that stamp. West Texas Intermediate became the grade. Cushing became the mailbox. The design was elegant on a whiteboard. Anyone long the contract into expiration had to take wet barrels. Anyone short had to deliver them. The paper market and the tank farm were welded together on purpose so that the price on a screen could not drift forever from the liquid in the steel. That weld is the quiet mechanism. Most of the volume never intends to touch a valve.
Hedge funds, swap desks, airlines, refiners, and exchange-traded funds buy and sell claims on future delivery, then roll those claims forward before the delivery window opens. The system works as long as somebody, somewhere, can absorb the residual wet oil if a position is held too long. Storage is the shock absorber. Cushing's tank farms, linked to the Permian, the Mid-Continent, Canadian flows, and Gulf Coast refineries, became that absorber for the benchmark that priced American crude. The contract specifies delivery into approved facilities. Receipts, tank tickets, and pipeline nominations are not metaphors. They are the legal objects that turn a ticker symbol into custody of a commodity that weighs hundreds of pounds per barrel and has to sit somewhere that meets fire codes. CME Group, after it absorbed the Mercantile Exchange, inherited that architecture and polished it. Clearinghouses net the bets. Margin collects the fear. The delivery chapter of the rulebook stays stubbornly analog. By the late 2010s, the hub's working and shell capacity had been built out toward a figure the industry treated as a kind of ceiling, on the order of 90 million barrels of steel, if you counted the tanks that could theoretically be filled. Inventories rarely tested the roof. Contango, the condition in which later-dated barrels cost more than nearby ones, sometimes paid companies to park crude and sell it forward. Backwardation, the opposite, pulled barrels out. The tank farm breathed. The paper market assumed the lungs would always have spare volume. What most viewers miss is how small that spare volume is relative to the notional size of the bet stacked on top of it. Global oil derivatives, including contracts that never mention Oklahoma, still take their cue from the Cushing print. A few dozen tank batteries in the prairie become the physical governor on a price used in boardrooms and ministries. The governor is not a theory. It is a set of floating roofs, dikes, and interconnects with a finite number of barrels they can hide from the sky. The historical blind spot is the assumption that finance had outgrown geography.
After decades of electronic trading, the delivery clause looked like a museum piece, a leftover from when clerks still used chalk. It was not leftover. It was the only thing preventing the contract from becoming a pure number, unmoored from molecules. And a clause that requires delivery is a clause that can be cornered by the absence of empty steel.
3 kinds of people thought they owned oil that spring, and only one kind had a place to put it. The first were the producers. In the Permian and across the mid-continent, shale companies had spent a decade learning to grow barrels faster than pipelines and politics could argue. Their incentive was brutal and simple: service the debt, keep the rigs from going cold, sell the stream. When prices cracked, they could shut in wells, but shut-ins are not a light switch. Reservoirs, crews, and takeaway contracts have inertia. For weeks, they kept pushing molecules toward the only mailbox the benchmark recognized. The second were the storage landlords. Names like Magellan, Plains, and other terminal operators around the hub did not need a view on geopolitics. They needed unused shell. In ordinary years, they leased space, moved batches, and collected tariffs. In a glut, their empty cubic meters became the scarcest asset in American energy. A company with a spare tank could name its price for lodging. A company without one could not pretend to be in the oil business at all. The third were the paper longs.
Commodity indexes, hedge books, and, most exposed of all, retail oil funds had sold the public a simple story: buy this ticker and you own crude. The United States Oil Fund and its cousins were built to track nearby futures, not to nominate pipelines. Their prospectuses mentioned rolls and contango in language most shareholders never read. Their incentive was to stay long, stay open, and stay easy to trade on a brokerage app. They had no dikes in Oklahoma. They had no firewater. They had a clearing number and a calendar. CME Group sat above them as referee and landlord of the rulebook. Its incentive was continuity, a contract that still converged to physical reality, a clearinghouse that could mark positions every night, a market that did not have to be declared broken. The exchange could change software. It could issue notices. It could not, in a week, pour new tanks. Watch the life or death choices compress. A producer decides whether to keep a well flowing into a market that may not have a home for the next cargo. A terminal operator decides whom to lock out when the last unused shells are spoken for.
A fund manager decides whether to dump the expiring month at any price or risk being assigned delivery of a commodity the fund is legally and physically unequipped to receive. A clearing member decides how much margin to pull from a client whose model never allowed a minus sign. None of these people needed a conspiracy. They needed opposite things from the same finite farm of steel. That is enough. The demand shock arrives as policy, not as a forecast. In March of 2020, governments close airports, factories, and highways. Jet fuel consumption falls off a cliff. Gasoline stations quiet. Refineries cut runs because finished products have nowhere to go either. At the same moment, Saudi Arabia and Russia fail to agree on cuts and briefly flood a market that has just lost its customers. 2 surplus stories arrive in the same month: barrels no one wants and barrels no one will stop producing fast enough. The excess has to travel. American inland crude, priced off the Oklahoma mailbox, moves by pipe toward the only place the May futures still treat as home. Inventories at the hub climb week after week. Trade press starts using a phrase storage desks hate: tank tops. Working capacity is not a cliff you can see from the highway.
it is a set of operational limits, mixing constraints, and unusable bottoms. Effectively full arrives before theoretically full. By mid-April, the remaining rentable space is a rumor with a bid attached. Contango explodes. Later months still price a world in which someone, someday, will burn the oil.
The front month prices a world in which that someone needs a tank this week. The United States Oil Fund, swollen with panicked retail inflows that treated cheap crude as a lottery ticket, holds a huge long in the contract, now staggering toward expiration. Other financial longs sit beside it. Rolling into June costs more every session. Staying in May means standing for delivery. April 20th is the penultimate trading day for that May book. Liquidity thins the way ice thins, first at the edges, then all at once. There is no mob of physical buyers left with permits, credit, and an empty shell. There is a line of financial holders who must be out before the delivery machinery starts. To exit a long, you sell. To sell when no one with a tank will buy, you keep lowering the price until the bid is not a price at all. It is a bribe. The tape goes vertical in the only direction left. Bids collapse. Offers chase them. Someone with unused storage or a swap that can absorb the assignment can demand to be paid for the favor of taking custody. The longs pay.
They pay because the alternative is worse. Take delivery under exchange rules, then discover there is no legal tank, no pipeline nomination, no truck rack waiting for their account. Breach is not a headline. It is default, margins, and a commodity you cannot park. Hours stretch. The nearby month becomes a market of last resorts. Calendar spreads scream. June still trades like oil. May trades like a storage invoice written in blood. The Energy Information Administration will later describe the same geometry without poetry. Low liquidity and limited available storage pushed the contract through zero. A later event study out of MIT Sloan will treat the session as a laboratory of forced selling, not as a referendum on the long-run value of petroleum. And then the session's damage is done. The people who could not take barrels have paid the people who could. The wound does not close cleanly the next morning. The final day of May trading still carries the stench of a corner created by absence rather than by a squeeze of ownership. Settlements farther out the curve remain positive, which is how you know the planet has not sworn off crude. Only the mailbox is full.
Dominoes keep falling after the open outcry in the mind is over. Some brokers discover their vendor software cannot post a minus. Some retail platforms halt, mismark, or argue with customers who thought a futures-linked fund was a barrel in a warehouse. Producers who sold production against the front month live a different math than funds that only owned paper. Storage owners who leased the last space collect a scarcity rent that no marketing deck had promised their investors in January. The barrier that breaks is not honesty. It is the unspoken promise that a liquid financial contract can always be exited for cash, in size, near a sensible price, without anyone mentioning dikes and floating roofs. That promise held for years because the tanks breathed. When they stopped breathing, the rulebook did exactly what it said it would do. It dragged the paper market down to the last cubic meter of Oklahoma steel and then through the floor. Leave the wound open. A civilization that prices energy on screens still drinks energy from pipes. The two systems shake hands at a handful of hubs.
On that April Monday, the handshake became a trap, and the people who had only a ticker learned too late which hand had the keys. After the session, the exchange had to admit a quiet humiliation of design. Pricing engines, margin systems, and vendor feeds had been built on the folk physics of oil. A barrel might get cheap, even humiliatingly cheap, but it would not require a minus sign. CME Group rewrote foundational models and notices so that negative prints could clear, settle, and be risk managed as numbers rather than as errors. That is not a software anecdote. It is an institution conceding that the commodity can, under its own delivery rules, become a liability. The retail wreckage was faster and less abstract. Funds that had marketed easy exposure to crude transmitted the fire sale into brokerage accounts. Billions in paper wealth tied to nearby contracts vanished for people who never intended to own a tank ticket. Some products changed roll schedules, warnings, and even their internal mix of months. The lesson arrived as a statement rather than a refund. You did not buy oil. You bought a calendar claim on a mailbox that can fill. Power in this story does not hide in a smoke-filled room. It hides in the mismatch of scale.
Trillions of notional derivatives can be written against grades, indexes, and lookalike contracts that ultimately nod toward a few physical bottlenecks: a tank farm in Payne County, a set of export berths, a strait, a refinery cluster. When those objects function, finance feels sovereign. When they clog, the sovereign is a floating roof and a fire code. The channel's subject is not a sermon against markets. It is the invoice. Who pays when a neat instrument meets a finite object? In that spring, the payers were the paper longs without steel, the producers who kept pumping into a full mailbox, and the ordinary funds that confused a ticker with a warehouse. The beneficiaries were whoever still had unused shell, credit, and the legal right to stand for delivery. Intention was hedging, speculation, even patriotism about cheap energy. Outcome was a forced transfer priced in negative dollars. Years later, a burning export terminal on the Baltic can still jerk a curve for the same reason a full tank farm once inverted one. Molecules move through places. Places fill, catch fire, silt up, or get sanctioned. The spreadsheet is a guest in those places.
Picture the prairie at dusk. White tanks, a flare in the distance, a pipeline marker half hidden in grass. The world's most famous crude price still has to come home there, or admit it was only ever a story. If the next bottleneck is a port, a chip plant, or a cable on a seabed, who will discover they bought a claim on a room that no longer exists?